What's up, everybody? Welcome back to the channel. Today I want to do a reactionary video with Josh Brown. He is the CEO for Ritholtz Wealth Management, and he has a couple interesting things to say on CNBC. He also has a pretty interesting investment strategy that I thought might be worth talking about. So anyway, let's go ahead and see what he has to say.
I was talking to one of the smartest people I know yesterday, Nick Colas, who I know you know well. Yes. And, you know, the main thing to keep in mind here is we have never had an inflation spike that was cured by anything other than a recession. Not all recessions have been caused by inflation, of course, but any time we've had a 5% plus spike in inflation of any duration, the answer has been a recession.
What's interesting about that is we actually have hit a technical recession. The government's saying we're not in a recession, even though quarter one we had a negative 1.6 GDP, and then quarter two we were negative 0.6. The technical definition is usually two negative quarters of GDP. So that's interesting you brought that up. We have technically hit a recession.
So, and I said this on the air, and I'm brawling with people, and nobody wants to hear it, and I know it gets repetitive, but we have 11 instances of that. So you want to roll the dice? You want to say this is the one that goes differently? I don't think that anyone should be doing that. So it's not fun to be bearish. It's not fun to be negative or pessimistic, other than if you understand that the carnage of today is planting the seeds of expected returns tomorrow. And as markets fall, two things everyone should be reminded of two things about bear markets. The first thing is they end all the time, every single one of them. The second thing, more interestingly, is that as stocks fall, expected returns go up. So the money that you're putting into the market today, it's the most uncomfortable investment that you could make, 401k or otherwise. Any contribution you're making, you literally feel like you're throwing money into a wood chipper.
Yeah, real quick, just want to add in on that. This has been the worst bear market I've been a part of, and I've been dollar cost averaging. I've actually put in way more money than I normally do, knowing that I'm buying the dip, and I'm just buying stock after stock after stock, and it keeps going down. I just know at some point it'll flip around, and I'm going to be very happy that I bought all this stuff. But is it hard to keep doing it? Conventional knowledge says to buy the dip, but actually doing it is a whole nother thing.
You're not. You just might have to be patient before you see that pay off. But there's never been a market like this that wasn't buyable. The real question is, what can you live with? Are you investing the right amount of money based on your own risk tolerance and your own financial situation? If you're not over-investing and you're not using leverage and you don't have ludicrous expectations about overnight gains and you're investing in a diversified portfolio, it could suck for another 6 months. It's entirely feasible, but that's not why we're doing this. We're not doing this so that we can have a party in March based on what the returns are from October. If that's what you're doing, you're playing a different game than most Americans trying to save for retirement.
Yeah, so real quick, a point on that. Basically, it's good to have enough money saved in your either bank account or checkings or whatever. Just have liquid cash. That way, if the market keeps going down, you don't have to sell, because you don't technically lose the money until you sell the stock or whatever. So just as long as you're putting money in there that you don't need in the near term, then you should be fine. Keep putting the money in, dollar cost averaging in. Keep some money on the sideline. That way you have a safety net in case this thing rides another 6 months, a year, who knows, 2 years. And yeah, if you're long the market for the next month or two, that might be pretty scary if you absolutely need stocks to go up in the next 2 or 3 months. That is not a good way to play the stock market. And I don't want to say play the stock market, to invest in the stock market. So I do believe the U.S. economy as well as the stock market will be much bigger in the next 3, 5, 10 years than it is right now. So therefore, all the investments I'm putting in and all these stocks I'm buying, ETFs, I do believe will be bigger in 3 to 5 years from now. So therefore, I think I'm getting a good investment, a good value on all these prices I'm getting in at. So this is just literally buying the dip. It is much harder than it sounds, though.
Right. And, we are seeing, as we talked about in the last hour, a lot of the things, these things go in waves. There's a sequence to how bear markets unfold. And part of it eventually is the stuff that people thought could keep them out of trouble starts to feel like it's getting into trouble, whether it's the big NASDAQ bellwethers or whether it's the stuff that's supposed to be, kind of safe. So that seems to be like it's coming around. And even on a more fundamental basis, I mean, FedEx, it's a quirky situation. The stock was really hit tremendously hard before we got these reports today of an incremental warning. It ended up down 0.5% today, right? So it's a dynamic system. Some stuff's been priced in, maybe not all of it. And I guess the question is, do you want to just sort of wait until it's more comfortable, or do you want to brace for, listen, the overshoots happen on the downside in a bear market typically?
So you're talking about the big safe stocks. They're finally starting to fall down a little more than they did to start. So it started off with the very small companies, all those stocks went down. Then the middle-sized companies went down. Now the very large ones like Apple's falling, Google's falling, Tesla's even starting to fall a little more. So that's what he means by the safe stocks. They're finally starting to fall. And the market definitely oversells to the bottom side. It also gets overvalued to the top side, which a lot of people think that happened like October, November of last year. So we're correcting not only from a overvalued top last year, we're to potentially an undervalued bottom now, or I'm not saying right now, but the next couple months, whatever, 5 months, 6 months, potentially keep bottoming. I'm not sure. Some analysts are thinking we're going to go down S&P to 3250, which is another like 14-15% down. The other part is talking about the mentality. If you're not able to take all these big changes, big losses in your account looking, you say you have 100,000, now you have 80,000, 60,000, it gets crazy. So it's really hard to stay disciplined. If you're not able to withstand those, then maybe you should get out of the stock market. But I personally think it's the best time to be dollar cost averaging into it. So before we get too much further in the video, please remember I'm not a financial advisor. Do your own homework on any type of investment strategies or stocks or ETFs that you're looking into.
Yeah, so I think you want to stick, if you have a strategy or a multitude of strategies in a portfolio, 2, 3, 4 different things, what you don't want to do here is start to violate the rules based on your gut instinct. So the tactical strategy that we manage for clients is technical. It's trying to be long in uptrends. In neutral trends, it's trying not to chop itself up and churn itself up. And in downtrends, it's just out. As badly as I want to say, this is it, this is where we buy them, that's not how it works, that's not the rules. But I do think a barbell approach, Michael, is probably the best approach for most investors. By barbell, I mean try to find places to go that have held up the best, because that's probably where the fresh capital is going to be chasing returns and coming in if and when this turns around. But then also buy some of the hardest hit stuff you can find, because that's where the opportunities could be greatest. So if you're doing that, then you're not betting on just strength or just catching falling knives. You're being rational, and I think you're putting yourself in a position to benefit from a multitude of scenarios. So really quickly, what's working? The ITA is something that I own, bought it earlier this year. It's one of the few things I own that's working well. It's defense stocks. Look at those stocks today. Some of them are actually green. This is an area that is the second best performing after energy this year. Almost nobody is talking about any of these names. And there's so much geopolitical stuff going on right now. These stocks remain bid. I like that approach. I'm in IEO, which is energy also. Then on the weak side, I bought semiconductors recently. I wish I waited till today. But like that's an area that there's been so much pain there already, right? That I think if and when there is a turn of the market, there's going to be a lot of money made there. So doing that barbell approach is probably better than trying to buy a lottery ticket or like hit the jackpot on one specific trade.
So it's funny you called it that. I'm actually already doing something like that. I never knew it was called that. I never really thought of it as how he explained it. But I have like 85% of my money that's in the stock market in indexed ETFs, like high dividend growth and the S&P 500. And the other 15% I do have in single stocks, which he called maybe like a lottery ticket or something. I have several different single stocks, so it's not just one lottery ticket. Some of those stocks have been beaten down 50%, 60%, 70%. Some of the ones I own, at least. There are stocks out there that have been beat up even more. There's some that have been beat up even less. Leave a comment down below if you guys think the barbell strategy is a good one to use. Maybe have like, a certain amount into what would be maybe a little more safe, less risky. It's also not going to go up as fast. However, and then have another percent in something that's like high risk. You could lose a little more money on it, but when things turn, it might boom up a lot faster. Thanks again for joining me today, guys. Let's end the video today with Pongo. We went on a little hike today, tested out the new photography lens I got yesterday if you guys are following along. Anyway, here he is laying down. I have him jumping over some sticks. Then this is him actually after jumping over some sticks. And here's him just sitting down being good. Anyway, leave a comment down below if you guys think Josh Brown's strategy is a good idea. Just in general, if you guys are staying in the market right now, if you guys are waiting it out. I know it's super scary to be in. So anyway, leave a comment down below. Smash the like button. Subscribe. Join the community. Thanks a lot, guys.